of the Brexit negotiations, and I have said, and I will continue to maintain, that we will keep an appropriate fiscal reserve so that if we need to, we can intervene to support demand in the UK economy.
Chancellor, are you comfortable with where the pound is right now? It's been pretty weak, and some say that, if there is a deal, you could see an upside of 17%.
Well, I have huge trust in the markets to effectively price all assets, including currencies, and we have an independent central bank that sets monetary policy, and as a matter of principle, I don't comment on the level of the pound.
Well, let's go back to Bali, where Bloomberg's Kathleen Hayes is now there with us, or with a finance minister for us. Kathleen, over to you.
Well, thank you so much, Francine. Yes, a very special guest. Another one, you might say. Grant Robertson is the Finance Minister of New Zealand, and he joins us now to talk about some of the very big picture issues that everyone has been discussing all week, and then, of course, some very specific issues for New Zealand. Thanks so much for joining us.
No problem at all.
Trade, we know that's probably at the top of the list. What does this trade war mean for your country? What ideas, what messages have been you sharing with your counterparts from Asia, from the U.S.?
Yeah, well, look, for a small open economy like New Zealand, we need a rules-based trading system. The multilateral approach to trade is absolutely essential for a small country like New Zealand. And nobody wins from a trade war, but especially a country like us. We're very reliant on exports to China and also to Australia, our nearest neighbour, as well as the US. And so what we're really calling for is an adherence to those rules. We need to strengthen that system. From New Zealand's exporters' perspective, we're not seeing a huge impact at the moment from the tariff war, but if it expands and if we see a greater level of tit-for-tat exchange, that will have a serious impact on our exporters and ultimately on economic growth in New Zealand.
Is there anything about, if you just look at it broadly, if we just took President Trump's argument as, we need fair trade as much as free trade, is there anything about that argument that's important to New Zealand and your exporters and your economy? Or would you have been happy just to leave the system as it is or was?
Well, look, there's always opportunities to tweak the system, and we're all interested in fair trade and making sure that out of trade we get good outcomes in New Zealand. And look, New Zealand has had to go through periods of adjustment with particular industries that haven't coped as tariffs have been removed, and I accept the point that we always need to make a just and fair transition, but ultimately those rules and the rules-based system is what enables exporters from a small country like New Zealand to compete well. And we're not asking for any particular special or preferential treatment. We just want to be able to operate in a market with some certainty and with some fairness. And unfortunately, this tit-for-tat war is really going to endanger that.
What are you most worried about right now, global growth or domestic activity?
Oh, look, for New Zealand, the two are completely related to one another. Our ability to generate good incomes for New Zealanders, higher wage jobs, relies on being able to export, which in turn relies on good global growth numbers. Like any government, we've got a number of domestic issues that we are focused on and making sure we invest in infrastructure, improve social services, but we look out to the world and we want to see global growth continue to be strong and solid.
The Kiwi, your currency, trading a bit below the level you had assumed in your latest budget, so obviously a bit weaker, and if it's having anything to do with trade war angst, who knows, maybe that beats it up a little bit more. But is that a bad thing to have a weaker currency?
Oh, look, I think, the New Zealand currency's been very high against the US for some time, and it's down in the mid-60s. Some would argue is probably a more sustainable position than where it is. It's still very strong against our other trading partners, particularly Australia, where it's largely held up, actually. So that's a lot to do with the strength of the US dollar, obviously, but we're not uncomfortable with where we are at the moment, and we'll continue to ensure we've got strong fundamentals in our economy. I think that's one of the things about the New Zealand dollar, is it comes off the fact that we are an economy where debt is low. We are running operating surpluses. We are in a position where we're free from corruption, and so we're an economy where people look at and generally see a currency that should be fairly stable.
I want to ask you a question about your budget. Your looking for a budget surplus through June of this year, about 2.4 New Zealand dollars, bigger than expected. Yet you're arguing against any spending windfall, right? You want at least until you get fresh forecasts from the Treasury. So why not? Why aren't you just giving back a little bit of that cash?
Yeah, look, they're the accounts for the year that ended on the 30th of June, and yeah, they do show a stronger surplus than was forecast. Some of that's to do with the timing of expenditure, and actually that money is being spent now in the new financial year, but some of it is the result of a higher tax take and a strong economy. We are spending more, we're investing significantly more in infrastructure, and we have increased social spending, but it is important to have a buffer in our economy as well.
Really a quick final question. Does the economy need any more stimulus, maybe in terms of interest rate cuts? I think the central bank opened the door ever so slightly to that being possibly the next move.
Well, look, obviously that's an independent decision of the bank, and they've said that at the moment they're not saying which direction they will go in, but we believe we do have the fundamentals right in our economy. We'll be disciplined about our spending, but there are areas we do need to invest in.
All right, Grant Robertson, thank you so very much for joining us today. I'll go back to all your meetings and conversations here at the IMF meeting, World Bank meeting here in Bali, Indonesia. I'm going to send it back to you now.
Kathleen, thanks so much. Bloomberg's Kathleen Hayes there joining us from the IMF World Bank meetings in Bali, Indonesia. Now let's keep the conversation on trade. Still with us, Jean Boivin from BlackRock. Jean, we started the conversation with you saying, of course, you've been focusing on trade and what this exactly means for the global economy. I know I asked you like a million times, is it deflationary, inflationary? But overall, how difficult is it to actually judge, how the supply chains will change, which country will actually lose most when it's kind of like a fluctuating event?
Yeah, I think it was interesting to hear Minister Robertson here. The three things that I heard was so far they don't see the impact, which I think is reassuring. But he was emphasizing a rule-based system, which is exactly what is being questioned in this environment. We don't know what the rules are. That's creating all this uncertainty, and as a result, I would have been curious to see what's happening in New Zealand. But firms still need to make decisions, and I think as it persists, the question is, when will they start to make proactive decision, moving production in other directions, in other places, or just holding back? So I think we're seeing some evidence of that, but it's not very material yet, as was said. So whether it's inflationary or not, I think pullback from global trade, which has been a trend for the last 100 years, by itself, I think, has to be inflationary. We are going to be, as we're putting more tariffs, more barrier, we're increasing production costs, and that overall will be, I think, an inflationary pressure. The extent to which it is still, to be determined, but that's the direction.
Okay, what does it mean for emerging markets? So again, we say this kind of all links back to what we've been talking about, right? The fact that China could be more inward-looking, the fact that trade could actually hit some of the smaller countries that have very open economies. Through your research, are you bullish emerging markets, or do they not have much going for themselves at the moment?
So we think the emerging markets are part of the global supply chain, and we are, in terms of production, having had the ability to reallocate production, part of production in some part of the world where we have a lower cost to produce, has been helping keeping costs low and producing globally, and I think the EM world has been benefiting from that. So the EM world is exposed to intensification in trade wars and tensions. We think it's part of the reason why this year EMs have been underperforming. But basically, this escalation in trade has been putting the spotlight on more vulnerable spot in the EM world. So it's a combination of idiosyncratic story in a more tense world. That said, we think that all the stories about QT and the Fed being the cause of this, we don't think this is a big driver. And as a result, if we can see trade being contained as a phenomenon, we can see EM performing well for the rest of the year, which is our baseline, our view, basically.
Okay, what are the signs that actually trade is contained? So is it no further escalation? You could also have a trade war, I guess, that lasts for 20 years.
Yes, so I think no escalation will be already a good thing. Gaining more clarity. So we've seen the Canada, Mexico, U.S. Taking a good direction in terms of reducing uncertainty. To the extent that we see some development that are appeasing, we think EM would perform well in this environment in a near-term basis. But yes, trade war can escalate and can be there for long. long time, and then it's the uncertainty factor that's going to start to dent global growth.
Jean, thanks so much. Jean Boivin there from BlackRock stays with us. Now stay with surveillance, plenty coming up, including European Commission Vice President Valdis Dombrovskis. He joins us a little bit later on. That's at 12 p.m. UK time. I know we'll ask him about trade tensions. We'll ask him about possible tariffs on steel makers in Europe. And, of course, the big one, Italy, but also Brexit. We'll look at Italian bond yields next. This is Bloomberg.
Market Check, sponsored by Hewlett-Packard Enterprise.
Stocks bouncing back today from their 2016 low, the majority of sectors rising, led by the travel stocks. We've seen gold selling off, but it is on course for a second weekly advance amid the recent market turmoil, and crude oil there pairing at the weekly loss. The market focus shifting to Iran and the looming shortages.
This is Bloomberg Surveillance. I'm Francine Lacqua here in London. Now, the European Central Bank is in no rush to provide more clarity on how its monetary policy would be tightened. One of the ECB's most outspoken hawks, the Dutch Klaas Knot, has said that he does not want new policy signals for the rest of the year to see whether the Eurozone can withstand global stresses. Monetary officials who will meet in 2 weeks intend to phase out their bond buying program this year, despite uncertainties around Brexit and concerns over Italy's public finances. Well, still with us, Jean Boivin from BlackRock. Jean, first of all, when you look at Euro policies, is it Italy or is it actually what the ECB does in terms of unwinding its policies?
That is more important for the European outlook. I think both are important, but I do think that the ECB is not likely to provide update or news. So we just heard that they were in no rush, or they were advocating being in no rush to provide signals. I don't think this is so much about providing signals. I think the current environment doesn't justify an adjustment to the policy stance for a long time. And it's not about being quiet in terms of communication. It's about like no change, and I wouldn't expect that to change until well into next year. So I think the outlook is in line with the stance we're seeing here, and as a result, don't expect the ECB to be an important driver of markets. And we've been surprised by how the tendency of market to try to see an hawkish desire of the ECB to move early, and I don't think that's going to happen. Now, so as a result, what is more likely to be a driver or a news event in Europe? I think Italy is more important. We're watching that very closely. This has been, since the election, a factor that has driven us to more uncertainty in the European outlook. Does reduce a bit the confidence we had on the next few years for Europe.
When you look at Italy, are the markets misinterpreting. So first of all, there was a shock that it was 2.4 and not 2%. But at the end of the day, it's the kind of the two populist I guess leaders that have this very uncomfortable coalition that will decide.
Absolutely, but I guess from a market perspective, what it creates is the fiscal framework in which Italy is operating is unclear. How we're going to see, now an escalation with the European Commission. We have the Parliamentary Budgetary Office in Italy that also needs to sign off and has been, making noise around this. So we have uncertainty about the fiscal framework in Germany in a situation of a country that is heavily indebted. We also have, optimistic forecasts of growth for the next few years that are embedded in this plan, and so that's creating an environment that is more uncertain over the next couple of years for Europe and Italy. In the near term, we think a lot has been reflected in the price, so it's not like we expect that to be driving markets, but it's a concern that is with us and could be surprising.
We're just hearing also from Mario Draghi talking about Brexit, saying, look, a cliff-edge Brexit could harm financial stability, and Mr. Draghi saying that the onus is on the private sector to prepare for Brexit. Is there a danger that we're over-preparing for Brexit, or can you never be over-prepared for Brexit?
I have a hard time thinking we can be over-prepared. There's an important ramification for various part of the UK economy that interacts with the EU, and thinking about what plans need to be done, especially in the context where we don't have full clarity on the direction. There are scenarios where it could be very risky. So no, I think it's difficult to see how you could over-prepare for that.
Okay, what does that mean? Do you, should you look at worst case scenario, because actually we're going to see a lot of volatility? Does worst case scenario mean a constitutional crisis in the UK, and what kind of impact does that mean for the economy?
Yeah, so I think we need to think of situations where there's an important market reaction, where we've talked about impact on the sterling, but so there's a market reaction that could be important. I think for the UK that means having the room to maneuver. There's a fiscal aspect to that, but there's also the BOE that will need to be ready to respond. So that's part of the contingency planning, and for firms, I think it needs. It's not necessarily the baseline. We think we're still expecting a deal, and hoping that eventually we get past the noise, and it's not a worst case scenario, but there are scenarios where it could be more rocky, and we need to stress this along those lines.
So Jean, overall, what's priced in the markets? Are they expecting a deal in the markets? Is it? I mean, I've even heard chatter of actually the markets in certain cases expecting a second referendum, which just doesn't seem to be on the table.
Yeah, no, I think the market is. These are binary outcomes, and they're difficult to say. Is the market pricing Brexit risk? I mean, it's either one or the other. So I think what we're seeing right now is more in line with a smooth transition, some deal. There could be a range on what it means, but it's a kind of a okay scenario. So we're not pricing a big a stress scenario. I wouldn't expect that to be priced unless we get news that this is where we're heading for.
I know you've been following the IMF and the World Bank, of course, meetings very closely. Are we a little bit too optimistic still about where world growth can actually go, given that we seem to have a lot of risks, emerging markets, these kind of geopolitical tensions, the monetary policy that alone you could actually deal with, but together it could be a kind of a perfect storm?
So when the IMF took down the bit at the margin 210 for the next 2 years in terms of their growth outlook. So they are taking that on board to some extent at the margin. I think for good reasons, because our view is the backdrop is solid, and if we don't get into a full-blown trade war, we don't see a reason for this cycle to end immediately over the next year or two. So I think that baseline scenario is completely reasonable. But at the same time, if we were to see an escalation in trade, and partially in trade, as I have emphasized, we would expect this growth outlook to be probably too positive. But it's not the baseline yet. So at the end of the day, it's a pretty solid backdrop right now, and we could avoid, if the trade can be contained, we can avoid, a slowdown that is significant.
Jean, thank you so much. Jean Boivin, their global head of research at BlackRock, of course, joining us today. Now, stocks overall globally changing a little bit of a comeback. Some would even say a robust comeback today as strong data from China buoyed the markets at the end of a pretty tumultuous week. I'm looking at dollar. It's steadying. Treasury yields ticking higher. This is Bloomberg. Economics, finance and politics. This is Bloomberg Surveillance. I'm Francine Lacqua here in London. Now let's get straight to the Bloomberg Business Flash. Here in London is Sebastian Salek. Hi, Sebastian.
Hi, Francine. Brilliant. China sank by a record as shares traded for the first time since BMW secured control of their joint venture. Shares fell as much as 30% as several brokerages downgraded the car maker. Citigroup cut its price target by 73% and recommended selling over what it calls an unfair deal. China's Tencent Music Entertainment has reportedly postponed plans to go public amid a global equity sell-off this week led by technology shares. It was expected to list in the week of October the 22nd, but according to the Financial Times, the company and its bankers have made the call not to proceed. Tencent Music Entertainment declined comment to the FT. And that's the Bloomberg Business Flash. Francine.
Thank you so much, Sebastian. Now, Bloomberg Surveillance continues in the next hour. Tom Keene joins me out of New York. European Commission Vice President Valdis Dombrovskis joins us right after 12 p.m. UK time. Of course, the main questions that we want to put to the Commission Vice President is Italy. What happens if the Italians try to flaunt the rules? And, of course, Brexit. This is Bloomberg. dwindles down. Global stocks recover after a two-day rout. U.S. futures suggest a bounce back. Is China a currency manipulator? Well, the U.S. Treasury Department is said to think not, but Secretary Steve Mnuchin could still say otherwise.